Paul Hickey's with us. Paul, it's good to have you.
Good to be here.
Do you think the runway to a soft landing has gotten narrower or not?
No, I mean, I think we look at what happened this week, with the issuance coming in. The market has, we're down 1.5%, but we've been spoiled. That's not too bad. It's September. I think in this respect, the economy is in such an interesting position right now because I could come on today and argue that a recession is imminent, or I could come on and say we're early cycle. It's that nuts when you look at it. You look at leading indicators in the inverted yield curve; they're flashing warning signs of a recession. But when you look then jobless claims, yesterday were very low. We track momentum in economic indicators. You're looking at over 40 different indicators to track how their year-over-year readings are trending. July, which is the most recent data, that was the strongest month we've seen in a couple of years, and it's not the type of reading you see when you're on the verge of a recession. What we did see recessionary levels in this was last year. We were at recessionary levels for that the entire time. So we've seen a big bounce back. The indicators aren't necessarily really strong, but they're moving in the right direction here.
That said, you've posted charts looking at the avenue to getting to target on CPI. A few things need to go exactly right.
Right. So we had the easy work on the inflation has been done. The headline inflation, it's going to be harder, and that's going to be a longer process getting there. Next week, we're going to see at least 0.5% in headline CPI, but core is going to rise 0.2%. 0.2%. That's take the year over year to, I believe, 4.3, which is a 2-year low. So, I think the Fed when inflation was coming down fast, the Fed kept telling us it's core that matters. It's core that matters. Well, now that's starting to drift lower as well. It's going to be a gradual process. But I think what we're seeing is that and what we've seen officials say is that we can take a wait and see approach here. We can see what happens with the data coming in. You saw Kroger report that sales were slowing because inflation is cooling. You see Walmart lowering entry-level pay. So we're seeing a lot of these things suggest that the inflation pressures are easing a bit going forward.
The question, though, is how much of that is already baked into the stock market, which, as you started the conversation, has performed very well around this narrative that we could get away with a soft landing and continue disinflation. Yes.
So, the stock market certainly rallied on the pullback in inflation. But when you look at what you've seen, when you've seen the types of declines in inflation that we've seen, it has been a very positive omen for the market going forward. And a lot is going to depend on what continues to happen going forward. Do long-term interest rates start, rising a lot more? Do we see a new leg higher? They've been rising in the last few weeks here, but they're sort of stuck in that range, the 10-year, for the highs that we saw last fall and earlier this spring. So as long as we can stay in that level, I think the market can do, just fine.
I've seen some jokes this week that if you had bought Apple or Tesla on every China geopolitical headline, you'd be rich, right? Do you think this is all, as one analyst said this week, more bark than bite?
I'm not a geopolitical expert, but I would say it's more bark than bite. This is posturing going on both sides. We see a lot of noise, and in the end, not much tends to happen. And like you said, there was a rumor that Apple orders were slowing again. If we had, like you said, if we saw, a dollar for everyone, we'd be millionaires now.
We're going to get the ARM IPO next week, and I do wonder how you think that's going to impact sentiment, potentially flows. It's a big one.
Yeah, so it's a lot of flows coming in. It's more supply, but just look what we had this week. We had a ton of supply coming in on the corporate side, and that in the market has digested that. It is September, okay? So we have to focus on that. And when you look back, take a step back, and you look at how the market's performed this year, it's followed the historical pattern almost to a T. And, that would suggest a little bit more weakness in the weeks ahead, but year-end rally. The third quarter of the year is the weakest of the 4-year election cycle during this year. So, I think that tells us that, you could see more weakness ahead, but earnings season just finished up, and we saw decent guidance from companies. We're not seeing a whole lot of hesitancy.
Right. Well, news flow is going to pick up next week, so we'll have a little more wood to chop. Paul, thanks for coming in.
Thanks for having me.